Well, good afternoon, good evening, everyone. Some you maybe good morning, somewhere wherever you are. It's again great having you all on this Wednesday's class. It's gonna be a little intense, so it's gonna be a little more academic, but also, as always, I want to make sure that the lessons that we learn during our classes is applicable immediately, so it's not just a theory. So I thought tonight would be a timely uh, uh, subject to speak about hedging and protecting our portfolios and find out the ways that we could use, as well as um, sharing a secret what institutions do and how they protect themselves from the gyrations of the markets. So with that in mind, again, welcome. A disclosure I have to put in because sometimes I come up with these ideas. I just want to make sure this is just educational purposes, and I want to make sure that's understood. So we're talking about hedging, and what does hedging really mean? So hedging doesn't mean hedge the, the bushes and other things. More likely, hedging is really like insurance policy, protecting your portfolio, your assets, and how to minimize risk. So the biggest goal or the main goal of the hedging is reducing risk, but it doesn't do it completely. So you have to kind of come to a level that you feel comfortable is an accepted level. And if you understand what level that is, then it is easier to implement the ideas. So the first rule of hedging is you have to understand what is your risk tolerance. What is that sleeping um, not well at nights and being up middle of the night? Where does that happen? So as I mentioned, the hedging or the protecting is not perfect. None of them work because nothing is static. We live in a dynamic world. So it is the best effort, I would say. So one of the most important thing is also you want to know what risks you are hedging against. So is it a loss of part of the asset? Is the volatility? Is it the time? So it's important to know what asset classes and what kind of um, a criteria you're using for hedging. Now, on the other hand, you also could have a portfolio, but would you like to maybe hedge an individual security? Maybe you are concentrated on one security, or maybe you did all your research, but because of the market gyrations, you're not sure for next month or 2 months or 5 months. It is in the long term, you know it's really good, but you want to protect yourself in the short term. So you could either protect yourself against individuals or maybe the whole portfolio. Maybe it is your 401k, your retirement account with IRAs or Roth or your individual accounts. So basically, that's when you have to make a decision which one you want to hedge. Also, you want to have a projection. You want to know, okay, I'm hedging because why? Because my outlook is, for instance, I feel the volatility is picking up. There's a lot of question marks with the elections coming up. So I feel that the markets, there's a good chance they could go down. And because of that, I want to make sure I'm protected. But also, I feel, all of this is happening because of maybe, again, the elections, maybe there's, again, with the Congress, all the um, uncertainty, but maybe in 6 months or a year, I think the things could be better. So whether I need this insurance is a more of a temporary insurance or this is going to be ongoing. You have to make that decision. And then you also want to understand your portfolio construction. What I mean by that, you want to see if you're heavily loaded with technology stocks. Do you have alternative investments like in commodities? Do you have currencies? So you have to know your asset construction and understand their correlations to each other. And also, what you want to understand is, great, I know where I stand, but the tools that I'm going to use to hedge this, do they match the assets that I have? And because of that, that's what the biggest drawback of hedging. Number one is the cost. We will talk a lot about that. The second thing is the mismatch of tools used. So you could have maybe your account is full of financial oriented and very defensive with discretionary, and then you're using, let's say, NASDAQ or QQQ to will show the technologies, techniques and on that. So you want to make sure you use the right tools. The other problem with hedging is it is dynamics. I mean, what is happening, the level, the markets don't say, all right, you're glad that it's today like S&P, the spiders were like at 340 and S&P is at 3,400. S&P doesn't stay at 3,400 forever. So it goes up, it goes down, Apple goes up, Tesla goes up, goes down. So because of that dynamicness, what happens is you really have to reevaluate every few weeks, maybe months, depending on what tools you use. All right, so that's what hedging is. One important thing I have to mention, and that's the reason I chose this, the visual graph on the right, is you don't start hedging when the house has already burned down, and you don't buy the insurance. You buy the insurance when everything is looking good. So when the markets are high, and that's when you have to start hedging, not when the markets are in the bottom. So I think this is as good as a time that you should rethink, at least in the short term, maybe using some of the vehicles and tools that we will discuss. What I'm going to go over, and that's what the element of time, I'm going to be quick, but we can always continue this maybe on Saturday's classes. But I like to show you some of the things that I've used before, and there are about 12 strategies. So you might be familiar with a few of them, but I just want to give you a comprehensive package so you have them. And also we know about the personalities, right? We talk about the psychology, about your mindset. We want to make sure that you know who you are, and because of that, then some of things might not work, but some of them, they might fit your personality and say, aha, this works for me. So there's the 12 of them. From the simplest one is, okay, you can sell and change to cash, to using stops, to all the way to the last part will be but the secret sauce that I'm going to share with you, the two strategies that the institutions use, especially when there's larger portfolios, and what do they do. So let's start with the first one. The first one is a simple one. Let's say you cannot sleep at night and you like to, again, the markets are in a good place. You feel, you know what, I like to see the elections finish, maybe end of December or so, everything is kind of more focused and there's a clarity, then I can get back to the market. That's the simplest way. So that's not really hedging, but it is kind of hedging because the cash is an asset, but that gives you that peace of mind. The second thing you can use, that a lot of people use it, so you can use stop losses. Or if you want to be a little more advanced, then maybe you can use trailing stops. By trailing stops, obviously, it allows you at least have a predetermined objective. So if the markets that have gyrations, then you have to accept it. But if they keep going up, then you don't have to worry about being out of the markets too soon. So that's the simplest way. So you can sell, use stop losses or trailing stops. The second part is also, it's kind of simple but complicated. Not a lot of people use it. People who do use, they're mostly professionals. Unfortunately, in the hands of like people who are not experts, it can become very dangerous when you use the short selling. In the short selling is basically you bet that your asset class could be indexes or your company of your choice that you own holdings, you're going to bet it's going to go down. So you borrow the shares and you will purchase from your broker, and then you will purchase them back hoping that it will be much lower price. So the danger part of the short selling is, again, the things when they move fast, and obviously the downside risk of any stock is zero. So at least when you buy a holding, let's say $100, the most you will loses $100. It goes from 100 to 0. When you do a short selling, imagine people who did the short selling on Tesla when uh, pre-split, it was like a 200, 300. They thought that's really expensive. It is one of the highest shorts of in the market of the securities, and yet imagine when it went over 2,000. So if it was you owned that 300 went to 0, you would have lost 300. Imagine from 300 to 2,000, you lost 1,700. So that's the danger of short selling. So you better leave that for the professionals. But there's other tools that we could use, and that's what I'm gonna go next. So short selling, I do not recommend unless you're really in command and you do like short-term trading. You are, you have a very good stop losses. Your risk management is very much in tune with it. So basically, again, it's not something I recommend for, let's say, for your portfolio, for instance. The most popular way that a lot of individuals and some money managers use is something called using the put options or protective put. And protective put, what it does, you choose the selected option. And as you know, with the put, when you purchase an options, with the put options, it allows you, or you're putting that, so it's putting down, that means that you're hoping that if the market went down, you basically are protected because you can purchase it back at the lower price. So in a sense, it gives you a very defined risk in the sense that knowing that, all right, I have $100 position, I can handle it to go down 10%, let's say to $90. So you buy a put at $90, and then anything under $90, basically you're protected. So in that sense, you give it a put, you purchase, and anything goes to 80 or 70 or 60, you basically, you're in the money. So in that sense, you only risk $10. So the protective put is also something called married put. The difference is with the protective put, you can buy it any time. And what happens is, let's say today you have a $100,000 portfolio, you let's say it's all in spiders, or you're on S&P, you purchase the put, as I mentioned, if it's 100, you go to 90. At least you know, okay, you can take $10,000, but anything more than that, you cannot take. So that's called protective put. The married put, that sometimes they intermingle with each other. Married put is similar to purchasing a put options. The difference is with the married put, I buy it at the time of that I entered that purchasing the stock. So basically, immediately I know what is my risk control. So I would at the same time. So now the stock can go up, but as long as I have that put option, I know I will be protected. So why not everyone would do this then? I mean, if that's the case, this sounds pretty simple. This sounds pretty attractive, actually, knowing that, okay, I can protect 5-10% of my, up to, after losing 5 or 10%, I'm completely protected. I can take that. And yet, I can use the upside potential. The problem with protective put and any type of put options relies on the cost. Because what happens, if this is very temporary, I can see that. So let's say you buy 30, 45 days, you think it's the election, maybe 2 months. But if you want to continue it, again, it's like an insurance. If this is the hedge would continue, then for the next 12 months, you have to buy 7, 8 different contracts, different times, or you have to roll it. So when we analyze and we look at the percentage of the cost of that put options relative to the portfolio, all of a sudden you're paying 10 to 11% for having this protection. On the other hand, the average S&P has gone up, let's say 9% or 10%. Well, if I know it's going to go up 10%, but I'm going to pay 11%, well, I better be in cash. So these are the things that you have to be wary of. as far as protective puts, but also in times like this, what happens is the volatility also affected. So let's say I bought a 30-day put, there's a volatility, now I have to roll it again. I think, well, there's more hedge needed, all of a sudden the put price is actually higher. So in that sense, again, this is a simple way, but you have to be very careful how to um, how to use the strategy because of the cost. The second, well, let's say the cost was too much, so maybe we can be a little more creative. So another option that you have is you can actually do a debit put spread. So basically you're bearish about the market, but you are not too bearish. You think you can handle up to, let's say if it drops 20% or 15%, something like that. But you don't like to pay so much for it. So basically what you could do, if you think the market is going to drop again, in this case, ABC stock is at 100, what you could do, you would buy a 95 put, in this case, that's about $5 less, so you have it's a debit, and then you sell the 85 puts to finance this. So in reality, all the premium that you paid 95, some of that money is back to you. So in that sense, you're limiting your out-of-pocket money, and you can keep doing this. So it just makes it a little more favorable as far as the cost side of things. One of the most popular things that a lot of portfolio managers have used, believe it or not, since the mid-1970s. That's, a lot of people think this is such a, it is a really new idea, whether it's a new revelations, but it's a collar. What collar is almost like a risk-free, becomes like a risk-free asset. So what collar means is you are really worried about the market where, again, because it's so overpriced, you want to protect your assets. And what you do, you basically, your asset is $100. You buy the put, the amount, the place that you feel very comfortable. In this case, let's say it's $5 less, so you can handle that. So you buy a put for 95. In this case, you pay $1.30. And then you sell a call at 105 for very close, because they're supposed to be, in real world, ABC stock is 100. If you go spread 5, they should really call and put in a theory, they should be equal, but they're not. But anyway, they've become pretty close. So in this case, you sell the call at 105 and you get a credit. So basically you're financing that put side. Remember, one of the biggest, as far as criticizing the put options was this cost. So here, you actually protect that. So in this case, you finance it and your out of pocket is 20 cents. Now, most important thing is with the collar, you have to make sure they're equidistant. So you don't buy a 95 put and then get a 115 call. That's not a collar. So you want to make sure that the kind of you pay as little as possible. Now, one of the problems with the collar is it's obviously because you have sold the call, in this case, like 105, it caps your upside potential. What that means is ABC stock jumps and goes to $120. Now, people who actually bought the call from you, they want to exercise it, and you're obligated to deliver them at your shares at 105. So that's a negative side about that. Again, the upside potential. The good thing is your downside is protected. Now, one of the things that it's important to know, the callers actually have saved billions of dollars for someone like Larry Ellison, right? He, from Oracle, in the bubble of 1999, 2000 bubble when it happened, he bought color on Oracle. The same thing with Michael Dell. Dell did that as far as Sun Microsystem. So Mark Cuban saved close to $1 billion. So these people have done, because of actually it was Larry Ellison said billion, hundreds of millions Mark Cuban saved by using this color strategy. because now they had the certainty and they knew at least their stock is protected, whatever, because remember the stocks went just so high. So they didn't mind maybe losing a 5% upside potential, but they knew they were very much protected on the downside. So what happens with this is it happened, it was so attractive for the people, like again with the insiders, that now it has become illegal for insiders to exercise callers. So they cannot go ahead and do callers on their own stocks. So just a food for thought. So with callers, what I recommend, you can use about 30 to 70 days to expiration. It's a good number. You can go higher or lower, but most of the time that's the best number to use. And the problem is the SKU. Now, SKU is, it brought up, on Saturday, it told that, again, in a perfect world, the call premium and the put premium, they should be equal, but they're not. And one of the reasons is a lot of portfolio managers actually, they use color. So remember, when you use color, you're buying the put. So when you buy, what does that mean? There's demand, and that's what the ask price and this spread, it goes up. So buying the ask price, there's more demand, so that put price goes up. On the other hand, when you're selling the call, when there is obviously there's a lot of supply, now you actually selling it. So what happens is the bid. So that's why you have this discrepancy, and that's what the SQ comes up, and that's the problem with the color in a sense. So it's not a perfect world. Again, it does limit your upside potential, but also, again, it also helps you with minimizing your risk. And this is just a little graph. As you can see, we are flat. So anything below, in this case, $95, I can sleep better at night. Actually, 95 minus, again, premium, but then remember I received the premium from here, so it was kind of a wash. And then I cap my my potential return. So my profit is fixed, my risk is fixed. There's another strategy that kind of helps a little bit to solve that problem of the financing, is something called fence. So with fence, it's pretty similar with the color and the put spread. So what you do, you actually buy a put with the strike price just below, let's say, the current value. But what you do, you sell another put to finance that put. So that's the debit spread. But then it allows you to go and buy a little higher call in order to have a break-even kind of a, low out-of-pocket premium. Then instead of buying maybe 105, maybe you can go to 110, 115. So in this case, it is pretty low cost. It protects you on the downside, but it also allows you to have a little higher upside potential. All right. So again, in the interest of time, I just want to go a little quicker. So this is called fence. Another idea you could use, and I've talked before about this, is diversification. Maybe you're heavily concentrated on the technology or real estate or financial. So diversification is actually not a bad idea. Maybe you can sell some of the more market-related assets that you have, and maybe use a different asset class, maybe become a little more international with the local relations. Maybe if you're doing bonds, or if you can do maybe laddering them by 5-year and 10-year and 2-year, and maybe go small cap, large cap, mid cap, and then you can revalue, and again you can use commodities, and those are the things that help you. So one of the things we talked before is the correlations. I'm not going to go more about this. You can study it on your own, but basically you want to have assets that they have low correlations to each other. So if the S&P is going, it's going up, maybe you have an asset that it doesn't go up as much, or maybe go the opposite. We've talked about corn, for instance, too, or agricultures. they have their own world. The sugar, for instance, coffee, they kind of independent of what happens with the, let's say, US stock market. So you want to have a low correlation between assets. Below zero point 0.7 is good. If they have negative, it's even better. Usually currencies play a role. So that's another way of maybe lightening up a portion of your portfolio and moving to some independent kind of assets. The other thing we've talked about, beta is very important. So a beta of 1 is the indicates that the volatility of market is the exact same as, or your asset is the exact same as, in this case, S&P 500. That's, so it moves with that, it moves, if it goes up, it goes a dollar for a dollar. But if you have a low beta stock, that means if it goes, if S&P is going up, this will only go up to percentage of that. So if the beta is 0.8, if S&P is up a dollar, that will move up only 80 cents. If the beta, on the other hand, if it's the S&P goes down a dollar, this only goes down 0.8. So it's important to understand, and you will see in the later slides, this beta is an important factor in your strategy. Another way of maybe protecting your assets and hedging them is maybe using ETFs. So again, you're heavily concentrated in the market oriented like S&P 500. Maybe you are with the FANG stocks, a lot of those, but you're thinking it might be, I do have some cash, or maybe I'm overweighted. Maybe I can sell a little bit of this and maybe move to something more independent. There's some ETFs available that you could use that they are very low. They have very low volatility, even they actually make money when the markets go down. So these are kind of, there's a new style of investments have come. This is, these three are symbols. You can look into that. They are from Innovators ETF. They almost look like an indexing. They put a cap that how much money you could make, but they also have a bottom that you cannot lose, for instance, from more than 5%, more than 10%, and that constantly changes. So this is like the September issues, and then you will have like October will come. So you can actually use this, basically maybe kind of having a low volatility portfolio till the markets kind of stabilize, and then you can get back to the market. There's also other ones are like the Swan tail, like for instance, tail does treasuries, plus they use options, and they use a different strategies that they can take advantage of upside while they have protecting kind of the downside. The SPLV follows the S&P, but the low volatility, they use low volatility stocks of S&P. And there's a new one, it's like Flight, which is like flight quality, and it is more of, again, protected. So these are more of innovative and new kind of ways that maybe you can park your money for now. You don't want to be away from the market in the meantime, but you want to have lower risk. So these are some ideas. And obviously, the other idea is like pretty attractive. You can actually, if you're really concerned, again, I'm thinking next 2 or 3 months, maybe you can use the inverse ETFs. The 3 most popular ones I want to put here, these are one time, and actually this should be EH, my apologies. So it's, I believe it's EH, I'll double check. But it's the short of S&P 500, so almost like a dollar for dollar, the opposite. The PSQ is the short of the NASDAQ and the QQQ, and then RWM is for the Russell 2000. So we have small cap, we have NASDAQ, and then we have the S&P 500. Now, one thing I didn't mention is the 2 times and 3 times inverse ETFs, and basically what they are is they are leveraged, they use futures. So I would not recommend using these for more than a day, or maybe the most is a couple of weeks. So these are good for like trading vehicles in a sense. If you think the markets are going to move pretty fast. You have this idea that maybe, again, we went outside the Bollinger Band. Like so that way, if you recall, I've talked about when they go way above the 20-day moving average, when the 20 days way above the 200. So you think we are pretty stretched. You don't know what's going to happen, but you think it's going to happen soon. Those are the times maybe you can buy TZA or buy SDS or QID or DXD. So that would be one thing. But they do have a drag. They do roll. They have the time decay. So there's a lot of things going into the picture that they are a wasting asset. So I would not recommend. Don't think that you can buy, let's say, TZA or QID for 3 or 4 months and protect your assets. So in this situation, you want to make sure that you only play for short term. The same thing with volatility index. With VIX products, they're really strange. So, I mean, you can, again, play it very short term. There's VIXY and VXX and SVXY. But those are not, again, there are more, I would use them as a short term and actually for more guidelines. NASDAQ just came with VIX. This VIX, obviously, as you know, it takes that 30-day options volatility of S&P 500. Now we have it for NASDAQ as well. They're just coming with new things and new futures products. So, but I'm not a big fan of playing VXX, for instance, for long term. So just a food for thought. So that's another way of protecting your investment. How about you think that, again, I know in the long run the markets will go up. I am very nervous right now. And let's say you have a large portfolio, you want to make sure that you're protected. So I use LEAPS. And what LEAPS stands for there is called long-term equity anticipation securities. So what happens with that is basically options, as you know, they go from weeks to months, and anything above a year, 9 months to a year and more, up to 2 years, some of them actually up to 3 years, that's called LEAP. So there are long-term options. And with that, you can do 2 things. Number one, if you want to, we talked about put options, you can buy, let's say for your portfolio, just buy a long-term put option. If you think for next year or so, you're not sure what's going to happen, you basically can buy based on your portfolio, buy a put option and protect yourself. On the other hand, maybe you could do something else. And I've recommended this when people have in their smaller capital. LEAPs become very attractive in the sense that they really require a lot less capital to invest. And so one of the ideas I thought, maybe if you have a lot of money in the S&P 500 oriented stocks, you don't want to be there, maybe it's a large portfolio, what you could do, you could maybe cash it or at least lighten up, and you can buy a long-term option, and in this case, like a SPY. So the SPDR, the S&P 500, they close at $340.12 today, for instance. Now, I looked at, let's say, if you want to buy something for December 21, you're pretty positive things have settled down. Most likely the market is going to go up by then. So, as you can see, the market makers think it's going to go up about $77 up or down. So that's one standard deviation. That's the expected move. So let's say you're not sure which way, but you really think that you don't want to be out of markets, but you don't want to have, let's say, $1 million portfolio sitting in the stock. So you can actually come and purchase a LEAP option of December 17, 2021, and the price will be, for the same thing, will be $32.57, or let's say $32. So for a holding of, as you know, one contract of option is $100, 100 shares. So when you pay for 100 shares of SPY, you have to pay $34,000. With this option, you pay $3,250 or $3,200. So you control almost the same thing for, let's say, the whole idea is it will expire by the time it expires, you're hoping it will be at 362 and $372 and more. So that's when you start making money, but the expectation was over $77. So by using 1/10 of the money, you're controlling almost similar. To be technical, because the delta is 55, and let's say you're gonna exercise this like in a year or so, in reality, you probably will need not 100 shares, maybe hundreds, in this case, 180 shares or 180 contracts to do the same, I mean, 180, 1.8 times and one contract. So 1.8 contracts you might be needing. So, but this is just another idea. You can use leaps on any liquid stocks. This is very important because the farther we go, you want to make sure that there is open interest. So you don't want to use it in some mid-cap size stocks, and we do need the liquidity, and you want to make sure the ask and bid is attractive enough. So this is something you have to think about when you do this idea, that this is another idea. So with that in mind, let's talk about what the professional, or I call it secret sauce. And with the secret sauce, this is what portfolio managers use. And although they implement some of the other ideas, but these are the two major ones that they use. Number one, they use the futures. And the reason is because that's the most cost-effective way of protecting your futures. I mean, your portfolio. So let's say you have a portfolio, in this case, I'm just using 1.7 million. This portfolio is very similar, and that's what you have to do a little study on your understanding where your assets are. So if you have a thinkorswim, for instance, that you can do beta weighted, and it will show you what is the average delta and the beta of your portfolio, for instance. If not, you can sit down and look at the percentage of, let's say, if I have Apple, and Apple is, 1.1 or 1.2 beta, and 80% is in Apple, well, then I know 80% of my beta is that, and then 10%. So you can actually calculate it yourself. So for our purposes, because of the timing, I use the beta portfolio of 1.1. That means for every dollar that S&P moves up, my portfolio will move up $0.1 more. If it goes down, I also will go down 1.1 times S&P. So, and let's assume today's close was at 3,400. This is the E-mini futures. Now, with the futures market, you don't really have to start trading the E-mini futures but it's important to understand how they work. Now, if you wanted to implement this idea with your portfolio, and if you have thinkorswim or TradeStation, make sure that you are qualified for it. There's a form you have to fill out. You just can't say, oh, this is great. You go and toss and then say, oh, it's great, I can buy this and that. No, you can't. You have to be approved for it. So it's important to do it ahead of time, so when the time comes, you're able to do that. So in this situation, what does the future does? Why is it attractive? Just because of the margin requirements. So you don't tie in a lot of your capital. And in this case, let's say for like mini S&P, for one contract, you probably need only like 4,200, depending on the broker that you use. That controls something we call notional value, because every point in mini S&P represents $50. And let's say if it goes from 3,400 to 3,401, I make $50. If it goes 10 points, I make $500. That's called notional value, which you multiply your contract value, and that's times the index where it was today. So one S&P contract notional value is $170,000. So what that means is, in this case, you have you can control with one contract, you can control $170,000. If you have a portfolio of 1.7 million, basically 1.7 million divided by notional value is 10. But because your beta was 1.1, that means for your, let's say your whole 1.7 million is invested, and again, that's the beta of your portfolio, you need to sell 11 contracts of S&P E-minis in order to protect fully 100% of your portfolio. Now, one word of caution, because today it's important and actually tomorrow is important. I'm using, this is the September. Now, starting tomorrow, we have something called rolling. And just a side note, the markets get a little crazy when the rolling happens. For the next 8 days, so actually the following Friday is when the actual options of December are going to be officially the contracts to be traded, but they start 8 days prior, which is tomorrow. So from tomorrow on, you will see the movement. People are rolling from their September contracts to December. So I could have used December, but this is actually, it's the most liquid right now. So that's what I did. So in order to protect, so this is a portfolio manager who has, let's say, $1.7 billion. What they do, they come and sell 11 contracts, and that way they can protect $1 for their portfolio. Now the question is, one contract is 170,000. So sometimes it's very difficult. How can we, let's say my portfolio is 100,000. Well, you know, what do I do? Or maybe 80,000. The good news is, there's actually just happened, you know, a few months ago, you actually have the micro E-minis, which is the 1/10. So you can actually implement this. Instead of 1.7 million, you could have a $170,000 account and use 11 E-mini, micro contracts. So this way you're actually protecting your portfolio. The cost is, again, it's $1 for dollar. Commissions are pretty low. And this way, you know, for fact, let's say for the next 3 months, you're protected if you're using the December. And that's what most of the portfolio managers use most of the time, using the futures market. This futures market applies in agriculture. If they have a background portfolio, if they have bond portfolio, they also use that. So this is a hedging that it uses futures market. The second tool used, which is, again, it's a secret sauce, is they actually use options. Now, if you recall with the collar, what was the biggest problem? The problem was that, first of all, put options are expensive. We did this, just single put options. The collar limits our upside risk, upside potential. So we have this in between. So is there another idea we can come up with that it gives us much more higher potential for upside and very low cost or zero cost, actually? That is called, I call it institutional hedge. There's different names. What you do, you actually purchase, it's very similar to color in some ways. It's you buy a put option, but instead of selling a call, you actually sell a call spread, except you call two call spreads. So just bear with me here. You have the stock or portfolio, let's say S&P 500. I'm just using that. It's $100. You buy a put, 95 put, which limits your risk 5% downside risk. You pay $1.20 for that. Then you have to do a little study to find out what is the best call to sell and what is the best call to buy. In this, we did a little study. So we found out if I sold the call 103, I can get $1 credit. And if I bought 107 call, I have to pay 40 cents. So I have a credit of 60 cents. So I paid $1.20 for my debit. I sold this call spread and I collected 60 cents. But remember, I will need to sell 2 of these. And because of that, then I can collect $1.20. My hedge costs me 0. I have a very good downside risk. I know I can go below the $5, and I have much higher upside potential because I'm using the call spread to cover each other. The big advantage also it is, because I'm using the call spread, I do have much less margin needed or capital needed for this strategy. So it frees up a lot. So let's think about an example. Let's say I use the SPY. You have to remember, again, one contract, option contract, is 100 shares. So everything we use is based on that. So let's say I have a portfolio of 170,000 and it's all in the spiders. So I'm all in the market. And again, today the price was $340. So in order to buy the put, because remember, I want to buy the put options to protect my $170,000 portfolio, 170,000 divided by price of the S&P today or spiders is equal 500. That means if I wanted to short this, I had to short 500 shares. But remember, each option contract represents 100 shares. So in this situation, 500 divided by 100, what I will need, I need to buy 5 put contracts to protect my SPY portfolio. All right. As I mentioned before, I like to use 30 to 60 to 70 day to expiration, so we can roll it if you need to do this continuously. This is how it's going to work. So you have to do a little investigation. So that's your expiration. So what put do we select? It's not just about, okay, it goes down, you know, I want to do 5%, 6%, but we also want to make sure it's attractive enough that we are not paying too much. So the delta that the institution most of the time they use is negative 26 to 34. And they offer the best buck for you, for what you need to do. So this to say a premium. Now, what do we do with selling a call? With the selling a call, we look for the, again, this is the near term. So we look for the delta similar to what the put was, 0.26 to 0.34. And then we find the buy a call with a delta range of 0.13 to 0.20. Now, this takes a little time, but once you fit it, the whole idea is you want to make sure that the credit that you receive from these 2 times 2 is equal to the premium that you paid. So we want to pay like 0 almost. So if you take a few attempts to create call spread, it has to be 50%. It might take a few attempts. So you pay 50% of the, I'm going to make sure it's 50% of the premium. That's where you get 2. So the other thing is, make sure when you are implementing this, you're going to really do it all together. But first you want to buy the put to make sure that goes through, you protect it, and then you can do your call spread. The other thing is I want to make sure you close your option simultaneously as a package, and don't wait to the last second. Don't think it's going to expire. Make sure you get out of it 2 to 8 days before expiration. What happens with this, a few questions might arise. Number one, let's say the situation didn't resolve itself, so you have to roll this over again. So you have to do some more studies, but it is dynamic, so you can see the cost is pretty reasonable. The problem you run into is, now we talked about the futures, but let's say you have a 401k, and your 401k is, as you know, it's like all predetermined, the funds that they offer. So how are you going to do this? So there's 2 ways you can do. You can leave your 401k. Let's say you want to do the futures or do this. Maybe you can duplicate that with your a separate account that you have, which is maybe investment account that you have. So you don't touch the 401k. Maybe use that account as insurance for your 401k. Because one of the problems I run into is like a lot of times we look at all our assets in a very separate buckets and thinking that, oh, this is my, no, at the end of the time, at the end of the day, this is all your money. This is basically everything works together. So 401k, you might not be able to do this, but maybe you have an IRA or you have, because IRA allows you to, most of them, they will not allow you to naked puts, but they would allow you to do covered calls, for instance. Some of them, they would allow you to buy puts. Um, Actually, one of the best, easiest wins are the Tasty Works. Tasty Work actually allows you to do everything within your IRA plus futures. So these are the things you have to think about. So if you have a regular account or if you have something that you have controlled, then it's easier. You can match it. If you have a 401k, on the other hand, then maybe you can match it from outside portfolio or investments that you can manage it yourself. So um, with that in mind, it's let me see, yeah, it's 5:55. So basically, just want to make sure we finish on time, and and then if you have any, and this is our website. So with that in mind, Sean, if you're still around, if we can start recording and start. If anyone has any questions, I'll be more than happy to answer.
Okay,
And,
sure.
and I hope that it